We at Centrum Broking are very pleased to host the FY18 results conference call for Borosil Glassworks. Today from the management, we have Mr. Shrivar Kheruka, Managing Director and Chief Executive Officer, and Mr. Swadhin Padya, Chief Financial Officer. I would now like to invite the management for their opening remarks, followed by which we can have an interactive Q&A. Over to you, sir.
Good afternoon, ladies and gentlemen. Welcome to our year-ending conference call for the year ended March 31st. I welcome all of you to this call, and I'd be glad to be talking to the investment community again, along with our CFO, Swadhin Padya. So we concluded our board meeting earlier today, and we've uploaded an updated presentation on the company website and also those of the stock exchanges. I can therefore briefly run you through the highlights of last year and recent developments, and then that will take about 15 minutes, and then I'll leave it open for questions that I'll hopefully address as best as I can. So for last year, overall revenues was about 432 crores, a growth of just over 15% over the prior year. We had a full year of class pack sales in FY18 as opposed to operations for part of the year in FY17. We had acquired class pack in July 2016. So on a like-to-like basis, our revenue growth was 13%. FY18 saw the implementation of GST in July. This was the reason for which we had a slightly soft Q1 and Q2. But we had a pretty good rebound and a high growth rate in the Q3 and Q4, the last two quarters. And we do believe that organized players like us will stand to benefit in the long run. By the second half, we saw that the short-term disruption related to GST had settled down. And if you look at the Q4 growth numbers themselves, in Borosil and the lab division, we grew 16%, and in consumer Borosil, we grew at 16.5%. So that was, good show in the last quarter. The reported growth in labware, including class pack, was 18%, and after adjusting for like-to-like sales, taking out the variability of the full year earnings in class packs versus only 8 months in the year before, the growth was 12.5%. This is in line of what we have been projecting, as growth for this division. The consumer division achieved a growth of 13.5%. Out of this, Borosil brand grew by 12.5%, and the Opal division grew about 15%. Lara's performance in Q4 was subdued because we undertook an upgrading of the manufacturing facility. As we had already discussed, we had expanded our capacity and added some new, more efficient lines. However, in order to do that, we had to shut down the furnace for almost 3.5 to 4 months, and we were out of inventory for some period of time. So the growth could have been much higher. Unfortunately, owing to this upgradation, it was a bit muted, but this is in the long-term interest of the organization, so it will definitely help us achieve a high growth number in this current year. Also, the Borosil consumer division grew, like I mentioned, about 12.5%. And if we look at, the latter half of the year, all the growth has come from there. The first half of the year was subdued owing to the implementation of GST. In SIP, the growth drivers of the business in SIP, we're supplementing the core laboratory glass business with our strategy of offering more products to the same consumer. So LabQuest by Borosil has been gaining acceptance as we explore the import substitution market. We intend to gradually expand the range, and we've introduced products like multi-tube vortexers, clinical centrifuges, tube rollers, tube disc rotators to this division. Like in the scientific products business, the initial offtake is slow because you want to prove the concept. People have to accept the brand. It takes time for them to do that, but I can say that the initial feedback has been very good, and over a period of time, this brand should increase sales quite rapidly. In order to bring greater focus to product design and development in LabQuest, we have decided to in-house these initiatives in a separate subsidiary, in a 100% owned subsidiary of the company called Borosil Technologies Private Limited, and this team will lead a design and development effort, so we can have an exclusive range of products which we can supply to our customers. Also in lab division, adding customers for class pack involves a longer lead time. And finally, we've begun seeing the results of efforts invested. And since the acquisition in July 2016, we've added 15 new customers, and there's another similar number of customers under approval process. The benefit here is that all these customers are really the top pharma companies in India, and we're seeing repeat orders from them. So I see that the thesis for having invested in class pack playing out, and I expect that to continue in the next couple of years. The third leg of growth in lab was exports. Exports was a bit muted this year, just marginal growth in the lab division. We had a couple of customers who had their internal issues who were unable to place orders, but I expect that to rebound in this current year. Coming to consumer growth drivers, our two primary drivers for growth in the near term are storage and opalware. Storage is performing quite well. There remains a large opportunity to convert customers from plastic to glass. Our high quality materials and product designs are both aesthetic and functional, and they're being very well received. We've got quite a good success in this category. Within storage, we've also launched a to-go range of products. This basically means on-the-go storage, such for example, our Hydra brand of flasks. These are made of steel, and they include vacuum-insulated stainless steel flasks and hot and fresh lunch boxes. Also, we have got a good response on this launch. The second category or growth driver is Lara. As I mentioned earlier, that we had an upgradation in our facility, so we had a small disruption in the supply. So that was temporary, but now the output of the furnace is stable, and we've got improved quality on the finished product, and I think this will add to a good year for Lara in this coming year. Coming to EBITDA margins, while our overall sales grew at 15%, the EBITDA from operations was at about 63 crores, which grew at 46%. So the operating EBITDA margin expanded to about 14.5% during FY18. Margin expansion was led by a more profitable product mix. Additionally, with growth in revenues, our company has begun reaping the benefits of operating leverage. Borosil registered a PAT of approximately INR 49 crores. After adjusting for a one-time gain of almost 91 crores in the previous year, the growth of PAT was 52%. So overall, I would say a very satisfactory year. It was upset by GST. The numbers would have been probably better, but I would say that GST in the long term is exceedingly positive, and therefore we will see the benefits of that in this year as well as the coming years. Medium-term outlook looks quite strong. Consumer products, both storage and opalware will benefit from a tailwind. There's a rising awareness of advantage of glass over plastic. That's for both health and environment reasons. And there's a rising aspiration of the middle class for a superior product, that is opalware. So we are, in both these categories, we are participating in, high growth categories. In SIP, while lab glassware is showing steady but moderate growth, the new avenues of LabQuest, ClassPack and exports will improve the growth trajectory. The company will focus on new product development. A task force has been constituted, and we expect to introduce dozens of new SKUs in this year as well as the next year. And obviously the older SKUs will be rationalized, the ones which are not contributing that much to sales anymore. GST, of course, as I've already mentioned, is likely to benefit organized players like us. And we are already seeing, more presence of branded products in shops compared to unbranded products. Our blended revenue CAGR is expected to move up to the high teens, and we maintain that long-term kind of growth path over there. EBITDA margins will expand further as company gets scale benefits and we absorb overheads on a larger base. The company will continue to grow its investments in both marketing and brand building. Sales are likely to grow faster than we expect as we expect marketing expenses to increase. The company completed the upgradation of its Jaipur factory, and efficiency gains are expected to improve the Lara cost structure. Higher volumes will translate into optimized freight costs and as well as warehousing costs, and we expect to improve EBITDA margins to between 15 and 20% over the next 2 to 3 years. So other balance sheet initiatives, we commenced the process of divesting non-core real estate assets, and we've released about 90 crores. We released another, that was the year before. Last year, we again released 64 crores in FY18. So I'm glad to say that a substantial portion of the targeted release has been achieved. The remaining non-core assets in the books is just about 4 crores, which we will try and attempt to offload in this year. Human resources, of course, are key. In order to align management incentives with long-term shareholder value, the company is implementing an ESOP scheme, which we already did last year. And investors are keen that the company shares are listed on the NSE in addition to the BSE. I'm happy to say that Borosil started trading on the NSE from May 25th of this year, just a few days ago. So, in conclusion, Borosil is in an exciting phase of growth. Having gathered some momentum over the past 2 years or so, my team and I feel confident about accelerating growth, building new avenues for growth, and also improving the company's margin profile. I'm now happy to take any questions that you may have.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Dhruv Agarwal from Cressida Investment. Please go ahead.
Yeah, good afternoon, sir, and congratulations on a good set of numbers. So my question more is, I wanted to understand how you segment your products under the standalone and the consolidated business. So correct me if I'm wrong, under your scientific products division, you take lab division, instrument, and the class pack, correct?
Right.
Okay, and under consumer product, you take container and Hopewell.
Right.
Okay, and the others include the flat glass as well as Gujarat Borosil, which accounts for in the consolidated business.
No, in the others, flat glass is a separate segment.
Yeah.
Okay. Others is hardly anything.
Okay, so flat glass, sorry, I did get you.
Flat glass is a separate. Yeah. In the it shows as flat glass.
Achha, flat glass, and so it should be.
But in the PPT which we have uploaded, there is no mention of flat glass. There is a mention of Gujarat Borosil right at the end. We have not consolidated the numbers of this through the PPT. Are you referring to the PowerPoint presentation, or are you referring to something else?
No. I am not referring to. I have not seen your presentation for this quarter. Okay. So I have this in my Excel. So I just wanted to understand. So flat glass is Gujarat Borosil.
That's right. That's right.
Okay. And that is accounted for in consolidated only, not in the standalone.
Absolutely right.
Okay. So in this standalone business of 296 crores which you have done for this year, what all divisions are included then?
Yeah, so just to explain that, and this is in the PPT, so when you see it, you'll get a linkage of the numbers.
Okay.
The Borosil lab division without class pack is there in the standalone as a part of 296. And the consumer division without Lara, without Hopewell, the 100% subsidiary is in the part of the 296 crores. So loosely put, I said 432 crores at the beginning, 296 plus 100 crores is Hopewell, and another 37 crores is class pack, which adds up to 432 crores.
Okay, so class pack is how much you said?
About 36 crores.
Okay, so that is for the whole of this year. So that is 432 crores.
That's right.
Okay, and the rest is Gujarat Borosil, which comes to around 646 crores, right?
That's right, something similar to that.
Okay. Thank you so much, sir. Thank you.
Thank you. The next question is from the line of Naveen Bothra, an individual investor. Please go ahead.
Hello.
Yes.
Congratulations, sir, for NSE listing and good set of numbers once again.
Thank you.
My couple of questions are regarding the NCLT process, which is getting delayed. Because in the Gujarat Borosil concall, it was told that around last week of May or June, it may get the completed NCLT process for merger and all these things. So what is the current update, if you can share?
See, NCLT has its own set of issues. They've been because they are dealing with much larger problems than merger of our companies because of all these bankruptcy proceedings happening in the last few months. virtually every time we get a date only for the next date. The judges are unable to hear the case as they are spending the whole day on other much larger matters. So our current hearing has been deferred to June 21st, if I'm not mistaken, and we are not clear when the hearing itself will take place. So that is the issue.
So
it's not in our control.
No. Okay, we appreciate that. But the process and the structure remains the same. Just the date has been increased.
At the moment, yes.
At the moment, there may be some changes.
Exactly the same.
Okay. So next question is regarding the 30th March board meeting. We have set up to only on subsidiaries 100%, DTL and Borosil Real Estate.
Yes.
So if you can clarify in the real estate, which non-core asset we are going to develop, or we are entering the real estate space as a...
No, we are not going to develop anything. The idea here is that we had some land in the company, a very low book value, and we want to transfer the land to that subsidiary, and eventually we will try and make sure we get the best value for that.
So the registered office address, if I am not mistaken, that is going to be developed, or which if you can tell about it.
No, nothing. There is some land near the airport, which is encroached. It's an encroached land. It is impossible to develop it also. It is historically encroached land for last, many decades.
So just transfer to Borosil Real Estate, and as and when the issue gets settled.
Yes, exactly.
Okay. And the second question is regarding the dividend policy. If I am not mistaken, last year dividend was also 2.5 rupees.
Yes.
Split. This year also we have given 2.5.
Yes.
So if we have adopted any dividend policy.
No, we don't have any formal dividend policy at the moment. We will be working on the same, but we have quite a bit of capex coming up in this next 12 to 24 months. So we wanted to conserve as much cash as possible for capex and inorganic growth.
Okay. And the last question is regarding the Gujarat Borosil, that NCLT will take it on time, no issue. But the whole idea of Borosil management, which I appreciate very well, is to get the related party transactions out of the way and more clarity to all the shareholders.
Absolutely right.
In Gujarat Borosil, we are having 58% will be owned by both Borosil Glass and 17% will be owned by family.
By promoters, yes.
Yes, promoters. So, is there any proposal or process in the mind that this also 17%?
We understand. We have heard this feedback before, and definitely we understand it also. So we are working on there are many options on the table. We are evaluating all our options and seeing what best we can come up with. But in the long run, definitely the idea is to add to investor value for the company and clarity. So definitely we will see in the future what is the best structure to achieve that.
Okay. And the Gujarat Borosil fundraising, if you can tell a little bit about that one.
So that process is still on, and the project has started. We have raised some debt to start the project, and I think I'm sure I'm not involved in the day-to-day affairs. I'm sure, yes, but I can.
We will like you to be on the board of Gujarat Borosil also, sir. We will like you to, as and when the company becomes the subsidiary.
Yeah.
Because you are driving the Borosil now, so we will like you to be director there. Hope to see you someday.
Thanks for it.
And just now, concluding this part, I have one or two questions regarding Lara, which I will come again.
Okay, thank you.
Thank you. All the best, sir.
Thank you. The next question is from the line of Jinesh Joshi from Prabhudas Lilladher. Please go ahead.
Hello.
Yes.
Thanks for the opportunity. Two questions from my side. What led to an EBIT loss in the consumer wear division for this particular quarter?
Sorry, let me just check that out. EBIT loss. Where did you read that data from? Where did you get the data from?
The segmental performance.
Sorry, let me just check.
The standalone performance.
Okay, so what happens typically the fourth quarter in terms of total value has always lower sales compared to the Diwali quarter and other quarters. So the overhead expenses always. So there's to answer your question, there's nothing different which has happened in this quarter which has resulted in that. The margin profile of the division is the same in terms of the gross margin profile. It's just that there's a larger overhead, and Q4 sales are in the consumer division. Jan to March is always the lowest. So that's why there is a loss. If you look at the same quarter last year, you probably see the same thing or something similar.
In 4Q FY17, sir,
it's marginal plus and minus. So it's not the most important quarters for the business are Q2 and Q3. But if you look at the overall year's performance, you'll see that from 9 crores, it's gone to 15 crores of profit. So I would not read too much into that one quarter loss.
Okay. And so secondly, the employee expenses in this quarter was slightly higher. If I look at the quarterly run rate in FY18, in this particular quarter, the run rate was slightly higher. So any specific thoughts on that?
Yeah, it's. I think because the profitability of the organization gone up, there must have been. Our compensation is such that we do have a percentage of incentive payable or commission payable to our people for higher profitability. So they would just be enjoying, a bump up on their pay for that from that.
Okay. And sir, one last question. Can you share the sales and EBITDA number for Hopewell and Classpack? I'm not able to get hold of it. I don't think the presentation is up on the website.
No, it's on the website already. It should be up on the website already.
Okay,
and it's there.
The number.
I can share for Classpack, the EBITDA was about 4.7 crores on a sale of 36 odd crores. And on Hopewell, the EBITDA was 7.3 crores on a sale of about 100 crores.
7.3 crores.
That's right.
Okay. So just one follow-up on this part. I mean, in FY17, if I'm not mistaken, the overall performance of Hopewell was impacted due to certain write-downs and an additional spend on A&P.
Yes.
So that, what should I say, impact was expected to be negated in FY18. We were expecting some kind of savings on the EBITDA front. Yeah. But if I look at the overall full year performance, then in that case, for Hopewell, we have done an EBITDA of about 10 crores odd, which is not in line with the expectations, because the savings itself should be in the region of 13 to 14 crores if I consider the write-downs and the additional A&P spends which we had done. So apart from the shutdown, any specific reason why the EBITDA performance was not up to the mark?
Look, I don't know what numbers you're referring to, but I can tell you what I have in front of me. In FY17, our Hopewell EBITDA was 0.8 crores, which has gone to 7.3 crores, okay, in this year. So there has been some improvement. However, obviously, that's only a 7% EBITDA.
I'm looking at the full year number and not the quarterly number.
I'm talking about the full year number. FY17, EBITDA of Hopewell was 0.8 crores, and full year number FY18, EBITDA from Hopewell is 7.3 crores. Okay. Now, that's a marginal improvement to 7%. But the main reason why the EBITDA hasn't gone up further is because of the shutdown that we have taken. In almost 115 odd days, let's say 4 months, the company was out of production, and obviously we had built up some stock to account for that, but it's always impossible to plan the stock perfectly. So we did lose out on a fair bit of sales as a result of that, whereas all your expenses, your employee expenses, your the overheads are more or less fixed, very little is variable. So that has resulted in this. I think we'll see a pretty good turnaround. We'll see a pretty good improvement in this year, further improvement in this year.
Okay. Thanks a lot.
Thank you. The next question is from the line of Dhruv Bhatia from AUM Advisors. Please go ahead.
Hi. Congratulations to the team. My first question is to follow up on the previous participant's question. You have this year reported around 8% EBITDA margins in Hopewell.
Yes.
So what you're trying to say is that because of the shutdown in the last quarter, it has led to the costs were there, but there was no revenue on that.
There was some revenue. It's not right to say there was no revenue, but yes, the revenue was depleted substantially because of that. And the shutdown wasn't all in the last quarter. It was starting from the third quarter onwards. In fact, I think all of October to January was the period of the shutdown, if I'm not mistaken. But yeah, about 4 months we did have a disruption in the supply chain.
So what will be the sustainable EBITDA margins that you can expect in Hopewell?
Look, I think we should target 20% plus in that in Hopewell.
Is that a medium-term target or FY19 target?
In about 2 years we'll get there.
The second thing, just on the balance sheet, just wanted to understand, could you give us a breakup between the investments in non-current assets, which is of 162 crores? Could you just give us what the breakup is, as well as the investments in current assets of 187 crores?
Just give me a moment. I'll ask my CFO to work that out. I'll come back. Can I come back to you on that one?
Yeah, sure. And you mentioned in the start of the call that you have sold non-core assets worth 64 crores.
That's right.
Is that the flat which was supposed to be sold
yes.
during the year?
That's right.
And there is no profit and loss on that, so hence there is nothing in the exception item.
There is I don't know, it's a marginal number. Yeah, that's why it's not coming. You're right. That's why it's not coming in exceptional item.
Sure. And any update on the fundraising at Gujarat Borosil level?
Look, the fundraising is continuing. Like I already mentioned to a gentleman before, we have started the project on the basis of debt, which we have already raised, and the equity raising is continuing at the moment. We are confident that this should happen pretty shortly.
And what has led to the receivables going up, almost 25% from FY17 to 18?
I think if you look at the sales in the last quarter of the year, they have been higher than and I think that has resulted in a slightly higher amount of receivables. Our growth is 15%, so if you just look at 15% growth, you'll have a 15% increase in receivables. But a lot of the growth has been rear-ended or back-ended, let's call it. So therefore, we have higher receivables. But there is no change in the policies of the company. There is no estimation of any significant bad debt that we are likely to have. So it's probably just an operational thing. We have not changed any policies.
And would it be right to say that this receivable increase is purely because of Hopewell?
No, because this receivable, what you're seeing is it's on the basis of higher sale. Hopewell, we have not changed any policies at all. So it would not be for that.
And earlier you had made a comment that, you have CAPEX plans for the coming years.
Yes.
Can you just talk us through what the plan, where you plan to incur this CAPEX?
Yeah, so look, as far as I already mentioned a warehouse, that we are looking at a fulfillment center / warehouse in Jaipur, which will be a substantial chunk of CAPEX spent over there. We would be increasing our shareholding in Glasspack. That's one level of CAPEX. The second level would be that we would also be increasing, that's I guess, inorganic expansion. We would also be looking at increasing the capacity at Glasspack, which will require CAPEX. And finally, we're also looking for inorganic expansion opportunities.
And the Glasspack, the stake increase would go up to 100% or?
It may not be 100. It may be a step increase, but it may not be 100.
Thank you so much. And could you, if you could just get the clarity on the investments of.
Information is the annual report.
So you will of course get this in the annual report when you see that a little bit later. But just wanted to can you repeat what numbers you're looking to get more clarity on?
So there is in current assets, there's an investment of 187 crores.
In current assets?
Right.
Okay.
And in non-current assets, there's an investment of 162 crores.
Okay. So maybe if I can get your, if I can get your email address or something, we can send it to you separately.
Swadhi.
Yeah. Is that okay?
Yeah, sure.
Thank you. The next question is from the line of Rishabh Parekh from Sunidhi Securities. Please go ahead.
Yes, Shrivar, congratulations on a good set of numbers. Just had a few questions.
Yeah, sure.
What is the cash and cash equivalents currently on a balance sheet?
I think it's about 260.
Okay. And in terms of Hopewell, we just wanted to understand what is the kind of revenue growth you are looking for in the next couple of years?
I think we should at least aim for 30%.
30% year on year?
Yeah.
And what is the depreciation number for Hopewell?
I'll just tell you in a moment. I'll tell you in a moment. In the meantime, do you have any other questions?
Sure. What is the EBITDA for Y-Line?
Yeah, that's disclosed in the, you get this first, give me this. Yeah, the EBITDA was about 14.5 crores.
And
14.7 crores. 14.7. And the depreciation number is 840 lakhs, 8.4 crores.
And Y-Line EBITDA is 14.5 crore.
That's right.
And, when you are referring to the class pack numbers,
yes,
which is 36 crores of revenue and about 4.7 crores of EBITDA, is this 60% or is this 100%?
This is 100%.
This is 100%. And what is the depreciation number for Y-Line?
3. No, for Y-Line depreciation 3.3.
And for class pack?
3.4.
3.4. Okay, thanks a lot, Shiv. Thank you.
Thank
you. The next question is from the line of Rakesh Jain from Asit C. Mehta. Please go ahead.
Hi, sir. Thank you for the opportunity. My question was first on what was the utilization for the full year in class pack?
Capacity utilization is about 65%.
65%. And that would have been the same in fourth quarter?
Yes, more or less similar. It's slightly higher in the fourth quarter, to be honest, but we've also added new capacity in the fourth quarter. So it would look, capacity utilization in this business can never increase beyond 75 to 80%, just because of the nature of the business. So 65% is getting towards the mark where we would need to add capacity, so which is what we are doing at the moment.
Right. So if I look at the full year number at 36 crore and, we did about 9 months of class pack revenue of about 26 crore. So roughly 10 odd crore is what we did in fourth quarter, which was higher QOQ as well as YY.
Yes.
But on that, the margins, we did a little less. We are at 9% compared to 13.5% which we did in last quarter. I don't have the number for the last year on the corresponding quarter, but in QOQ it's down. So could you explain why is it that?
I don't think the margin profile is materially impacted in the last quarter specifically. I would have to come back to you on this point, but in general, the margin, the EBITDA margin I know has gone for the whole year, has gone from 5% EBITDA to 12% EBITDA in class pack. So on an annualized basis, I can share with you that we have done better. The last quarter specifically, I am not aware of any reason which may have reduced that EBITDA percentage.
Okay.
I think as far as looking forward is concerned, we can expect the margin profile in class pack to further improve.
As per the last quarter, about 13%. So, and before that, the highest we reached was 18.5%. So, where would you want that margins to be?
I think it could go north of 15% is something that we should aim to achieve in this year.
Okay. And in the Hopewell business, can you just tell what is the distribution range now we have reached on?
See, we are quite strong, in the north and in the east of the country, and in pockets in the south. West, I think we are still under-distributed quite substantially. And the rest of the south also we are under-distributed. So we are also adding some new product categories in terms of different shapes and designs to get into those markets where we are not present today. And that should help us in this year. So overall, I would say we can do better in the western part of the country, including Mumbai, and also in areas such as Hyderabad, Bangalore. These are places where probably we can do better. And that will be by adding certain new combinations and products which are today not in our system, but we are planning to introduce.
So what I wanted to understand is what is the breakup of our distribution right now in modern trade, e-commerce and the traditional?
So Hopewell e-commerce is virtually non-existent till last year. Overall, I would say e-commerce is about 7% of revenues, 7 to 8%. Modern trade would be about 25%. General trade is about 60%. And then balance would be CSD, CPC.
Okay. So is it likely to change, this breakup?
Yes, e-commerce will grow rapidly this year. We have certain strategies in place to ensure that. I think you see a jump in modern trade also, and trade will slightly reduce. Not that the overall numbers will reduce, but the as a percentage of the total sales, trade may reduce a little bit.
And in the last quarter, was there any price change in the products which we have done in the CPD division?
Look, price changes happen all the time. So I can't, in general, there was no price increase or decrease. It was more or less similar. But schemes keep changing and products pricing keeps changing depending on, various factors. So it would be improper for me to say that there was any, as a general rule, there was a price change.
But saying that there is some competition growing up right now, so would you be, taking that as a strategy to do it?
No, we can't reduce because you see, already the prices are very low in terms of you can buy a dinner set for 2,500-3,000 rupees. That's quite an attractive price point. I don't think there's any need to reduce prices further from this.
Okay. Thank you from my side. All the best.
Thanks.
Thank you.
Yeah, thanks.
The next question is a follow-up from the line of Dhruv Agarwal from Cresta Investment. Please go ahead.
Thank you, sir, for the follow-up question. So my question is regarding the container division. If you could give the EBITDA numbers for the container division, FY17 and FY18.
I'm sorry, we don't share that.
Okay, you don't share that?
Oh.
Okay, if you can give the growth rates are individually for the lab division, glass pack, container and Hopewell, you foresee going forward?
Okay, so going forward, I give it to you for the whole consumer division as a whole. We've been talking of a 15 to 20%, medium term CAGR that you can expect. And for the lab division, we've been talking about a 10 to 12% medium term CAGR. And obviously, we feel that there is a chance of, being slightly higher than this.
Okay, for both the divisions, you can be slightly higher than this.
Yeah.
Okay.
I'm talking about, I'm not talking about any 1 year, I'm talking about, the medium term kind of CAGRs.
Maybe 3 to 5 years perspective.
Yeah, right.
Okay. Okay, fine, sir. Thank you, sir.
Thank you. The next question is from the line of Aditya Deshpande from Vallum Capital. Please go ahead.
Hello.
Yeah, hi. Hello.
Yeah, hi, good afternoon, sir. Congratulations on a good set of numbers.
Thanks.
So, I just wanted to know what is the breakup of revenues in terms of exports and domestic?
This is mentioned here somewhere. You're talking about overall both the divisions put together or
overall consult?
Exports is about 12 odd crores. Exports are a very small percentage overall yet. The majority of the exports are coming from the scientific products division. That's really where we are focusing more on exports, over the next 2 to 3 years. Consumer division, our main focus is the domestic market. So I don't see that exports will be a major contributor there.
Okay, right. So like you said, majorly domestic contributes a lot to your revenues.
Overall, yes, it does. Domestic is the majority of it.
So in India, we have a large number of smaller regional players who seem to be very fragmented. So is it possible to quantify the unorganized sector in India?
No, unfortunately, it's not possible. But we think unorganized sector would be as large as the organized sector.
Okay, great. Any plans to increase
your market? That's our internal estimate. We don't know. This is just our internal estimate.
Sorry?
I said that is our internal estimate. We don't know for sure.
Yeah, okay. So any plans to increase your regional footprint among the unorganized players?
I'm sorry, I don't understand that question.
Any plans to increase the regional footprint among the other unorganized sector?
No, I can only try and increase my footprint. Now, at whose cost it will come, I don't know. But yes, we do have plans to expand our distribution, if that's the question. And we do have plans to increase our product portfolio to capture more share of wallet. And we are seeing with GST a trend towards more organized competition. And people are more aware of brands than before. And in fact, e-commerce is also helping in that sense, because people tend to buy products that they already have heard the brand name of. So definitely we will see a much higher growth of organized players compared to unorganized players in general, and therefore Borosil will be a beneficiary of that.
All right. That's it from my side. Thanks a lot.
Thank you.
Thank you. The next question is from the line of Kashyap Zaveri from MK. Please go ahead.
Yeah. Hello.
Yeah, hi.
Yeah, hi. Congratulations for a great set of numbers. Just one question. What was Vilene top line and debt in FY18 and FY17?
In FY17 or FY18?
Both.
Okay. Do you want the Vilene top line?
Top line and debt. Debt only FY18 will do.
Debt was from about 34 crores, give or take, in that range. Top line, it'll be between 75 and 80 crores. I don't have that number with me at the moment.
This will be in FY18?
Yes. And FY17 maybe 15% less than that. 15-20% less than that.
Okay. So if
I'll look to this because I don't have the exact numbers in front of me.
Okay. So if I look at, Vilene, we had a 14.7 crores EBITDA on an 80 crore top line. So that, company made about 18% margin. And if I look at our, standalone sales and, the EBITDA margins, the blended margins that we did in our standalone sales was roughly about, 17 odd percent. So I'm just trying to comprehend. A manufacturing company makes probably the similar margins as the marketing company does. So, do you have any comments on that?
No, you see, we have a...
Owning a brand, we should make more money than the manufacturing one, right?
Yeah, but you see, firstly, I'm not sure that always holds true, but in general, what I would say that as far as the margin profile is concerned, having a brand means you have to invest a lot in the brand itself. And that is what is depressing the margins. If you see our A and SP expenses have been increasing rapidly. And that's why the the percentage, let's say, of profitability is a bit depressed. As we achieve a certain scale, you see the margin expansion, and that's also happened this year. You can see last year the EBITDA margin, the blended was 11% which has gone to almost 15% in this year, and that will continue going up. Whereas I would say a manufacturing entity would be stuck at the same margin profile, and their growth may not be as aggressive as the growth. Now, coming specifically to, that's a general comment I have. Coming specifically,
spends in standalone for the full year?
The A&P spends, I think, for Borosil was almost 20 crores, if I'm not mistaken. Standalone. I'll just tell you in a moment. But I just want to answer your question on Vilene also. As far as Vilene is concerned, and as far as our company policy is concerned, we have a philosophy of global sourcing. So we are able to buy products or our